Good morning, ladies and gentlemen. On behalf of IndusInd Bank, I warmly welcome you to our Investor Day. Thank you so much for taking your time out. We have an exciting day planned ahead as we share our future focus areas. The day will commence with a strategic overview by our MD and our CEO, Mr. Sumant Katpalia, followed by presentations of individual businesses. I would like the esteemed audience to also know that we've set up an exclusive zone outside the ballroom. This zone will be open during lunchtime and after we've finished with all our presentations. Please take a moment to visit each one of these booths and get an experience of our offerings. Without any further ado, I'd like to invite on stage our Managing Director and CEO, Mr. Sumant Katpalia, to address the audience and set the context for the day.
Good morning and welcome to the investor presentations and the investor day. I think it's very important to do these type of meetings. It gives a brief, cursor and an overview of what the bank is doing and what is the bank all about. Why did it do the things which it did? And what is the way forward for the bank as we move forward? It's also an opportunity for you to meet and interact with the management team and see live some of the products and the capabilities which we have created or are in the verge of launching. I think the, the stalls out there will give you an insight into what IndusInd is all about and what IndusInd is planning to do. I think we've got a complete agenda for you today. I think I do my first presentation followed by the consumer banking presentation. I think important why consumer bank, because liabilities is a focus and we will talk about liabilities and what we are going to do on liabilities. The affluent banking, which is a new vertical of the bank. And what is it that differentiates us from the rest of the world? And why do we say affluent banking is going to be a big business for us? Vehicle finance, our domain specialization, followed by lunch, microfinance, again one of our domains. Corporate banking, the changed corporate bank. It's not the same corporate bank which you saw. I think what is the new changes which have happened in corporate bank? Diamond Group. I think a lot of people have questions about a diamond. We've never exposed a diamond head and the business in a detail. We will expose the whole and what do we do in the diamond business and why is it so profitable as a business? Our digital banking and I think the new way, we are not looking at this as an enablement. We're looking at it as a business unit. And I think what are we going to bring in the day? If we have time, we will go to the product groups. If we don't have the time, we will cut there and we will show you a brief cursor into a new product launch, which we are going to have, a new business launch, which we are going to do. And I think then we will go into the experience. There are many presentations. We'll cut it short if it's time is required to cut it short. But I think if we do it by 5 o'clock, I think we should be over. We will see if the product presentations can be accommodated today or not. I think the presentation covers 3 big parts. The first part of the presentation is really towards the backdrop to our strategy. Where are we coming from? What is it that made us revisit our strategy? And why did we do what we did? I think a brief preview of the past to look at things which were happening and how have we molded ourselves as we move forward. Are the building blocks in place today? We will show you some data on it and how are we looking. Whatever we said that we were focused on, have we moved ahead or are we still lacking on those data points? And how will we achieve the growth as we go forward? I think one thing you must remember, this bank has to be looked as a compounding bank and not as a volatile bank. It's a sustainable compounding 22 to 25% CAGR bank. That is how you should look at this bank as we go forward. Yeah, it will be a very, very predictable, sustainable bank. And that is what our focus was and that is what we have created as we move forward. I think before I go into the presentation, I think the operating environment has changed. And I think we must look at how the bank is coping up with the operating environment. I think a lot of buzz is around in the market. And I think it is very important to address that buzz. And that's the precursor to the presentation. Tightening liquidity. Oh, will the bank be able to grow? The questions which are asked is, will the bank be able to sustain its growth in a tightening liquidity? The confusion which is happening is liquidity, granularization of liability, and funding are three different issues. And I think there is a mix, and I will talk later in my presentation, how people are combining these three issues and creating an issue across the board. I think if you look at liquidity, yes, there is a tightening of liquidity. The RBI has sucked up liquidity from the system. We are now 2 lakh crore excess still in the system. But that doesn't mean that the bank is not liquid. We have an LCR of 125%, surplus liquidity of 47,000 crore in our balance sheet, and a cash deposit ratio of 82%. We have not gone to 95, 98% or 100%. We are liquid. Our growth is intact. And till we are able to touch 30%, 35% CAGR for the next 2 years, we don't believe we have a liquidity issue. And when we talk about the liquidity and the funding, I will talk to you how our funding is completely different from the rest of the industry. Competition of deposits, HDFC, oh, it's going to come. And everybody else will not be able to create deposits. As a consequence of that, the demand for deposits will go up. Yes, in a tightening liquidity situation, there is a rise in the COD. The rise in the COD has also been countered by different, retail growth which we have been doing. If you look at our retail growth has been 16% overall, and our deposit growth has been 15%, higher than the market, higher than the 9% growth with the industry. So to say that the bank will not grow and will be a competition deposit, we've said we will continue to grow liabilities at any cost and granularization of liabilities. I'm making that statement again. Healthy credit growth. We said in planning cycle 5, we will do 16 to 18%. First year got wrong. Second year was a complete washout with COVID-2 playing out. We did a 10% growth. This year, we said we will grow at 20% above. We're already at 18%, and quarter 3 and quarter 4, you will see the growth. We will touch the 21, 22% growth, which we have said, and our growth will be there to meet the targets which we have set for us as 16 to 18% CAGR over 3 years. And we will meet our growth targets. Interest rate hikes. I think, and banks like us, which are more fixed rate book of 52%, and a less floating rate book of 48% will have a NIM issue. Our NIM expanded by 4 basis points. Of course, the industry expanded, some of the banks expanded by 30 to 50 basis points. You have to look for yourself whether that NIM is transitory or is it sustainable. When we talk of our NIM, we talk about sustainability of our NIMs. And I think we will always be in the margin range of 4.15 to 4.25. We've always said that, and moving into a different margin range of 4.25 to 4.35 as we move forward. I think it's a very differentiated play. We don't have a mortgage book and 18% EMI increases in the mortgage book and 70% of NIM expansion happening through the mortgage book, which we don't have. Is a way which you have to predict whether that can continue to be expanded in the way that industry has expanded. But we are doing well on NIMs, and we will continue to deliver the NIMs and under the guidance which we have set. Improving asset quality. That was another one of the thing. People are showing 20 to 40 basis points, and I think, yes, we are in a benign environment on risk. The portfolios which we have are differentiated. Please understand, microfinance is 15%, 13 to 15% of our book. And CFD, which is the vehicle finance portfolio of ours, is 23% of our book. 46% of our book are prone to a little bit higher flow. And if you compare it with the industry, and we will show you, we are at least 40% better than the industry on these areas. You will continue to have flows, but we've said our guidance is 120 to 150 basis points of credit cost, and we should be able to deliver that guidance this year. And going forward, we have given a guidance of 110 to 130 basis points, and we should be within that guidance of 110 to 130 basis points. So let's start with the presentation. I think these were some of the concerns the market had, and I think I wanted to address them upfront. What happens is a lot of talk happens around these topics, and I think it was very important to address it. I think let's get down to the backdrop of the strategy. And I think before I talk about it, you have to understand what are the management beliefs and why have we got the strategy and which we've got. I think our business philosophy lies on two basic foundations. The basic foundation is we are a universal bank. We are not a microfinance bank. We are not a vehicle finance bank. We believe all segments and all businesses are profitable in this country, and that's why universality plays in this. We believe even the corporate bank is very profitable if it's done correctly. And I think we will continue to balance our growth and have all segments participating in our growth as we move forward. That's the number one hypothesis of the management belief. The number two hypothesis of our management belief is you must have a differentiator in the market. And that differentiator comes through the domains. 45% of our businesses are where we are number one or number two in the business. Growth is not important. Quality of growth is very important for us. And that's what domains over a period of 30 years of experience has shown how domains have created value for the organization and have sustained the quality of which we talk about in the businesses. And we will talk about this as we go later in the presentation. Our approach towards customers. I think we believe phygital is the way forward. We don't believe digital will take over completely or branches can take over completely. I think what is important, confidence will always come with the physical distribution. And I think the growth will be driven through the digital value propositions. And I think that is a mix of phygital and digital. And how you integrate that and converge them into a value proposition is what you will see as we talk about. It's not about enabling. If you do products and services which are available in a traditional branch, in a digital, I think it's not. It's an enablement. It doesn't create value in the long run. Those values are already embedded in your cost to income ratios. Everybody has achieved that. How you create a model which is differentiated from the branch distribution and create value which converges with the branch over a period of time is the value which I'm talking about and which is the way forward for this country as we move forward. I think personalization in client engagement, I think is very, very important. How do you personalize and create experiences which the clients want at his time and at his moment? And I think you will see what we are creating on customers as we move forward. I think on technology, three parts play a role. Is your infrastructure capable to manage scale? I think scale is the new buzzword. I think payments have scale. Digital payments are huge volume increases which have happened on the digital payments, whether it's on UPI, whether it's on cards, whether it's on IMPS, everything, I think. And how do you manage security as you manage your infrastructure? The cyber security risks are very, very important as you create this. The other is to deliver UI, UX. And I think there is a big differentiator. The banks were used to back-end systems and maybe a mobile device and engaging with the mobile. I think today's world is about UI, UX, and how you create a front-end capability, which distinguishes you in a very different way, and creates an experience for a client, I think is what technology is all about. The uptimes on the front-end systems, the uptimes on the experiences which we give to the client, and personalization which we give to the client, I think is all about the new technology. And I think governance. And I think the governance is all about the culture of the organization. Are you creating the right culture and right capabilities in the organization to take care of sustainability and continuity of the business? And I think the management belief is all about the sustainability is very clear. Quality of earnings is more important than the quantity of earnings. It's a very big statement which I'm making. Please remember, the bank will always focus on the type of earnings which you will see are more granular, more annuity driven, and more process and technology driven. And I think that's a big differentiator which you will see in the management belief as we move forward. So what is IndusInd? What do you like IndusInd for? I think it's a diversified franchise. It's a very different franchise when you compare the big banks and us. You'll find this franchise has unique propositions which are very, very differentiated. If you look at our domains, we provide livelihood loans. 43% of our business comes from these domain specializations. In every category, you will see us number 1, number 2 in that category of domains. As a consequence of these domains, our funding profile is completely different. These are not domains which we have created. These are businesses which have been there for 30 years and have seen differentiated cycles, different cycles on geopolitical risks or demonetization or even in the pandemic, and have come over and continue to sustain themselves over a period of time. And I think that makes us a very, very differentiated, a large bank with holding domain specializations, 3 domain specializations of a very differentiated nature. And all the 3 will present to you today in a very differentiated way. Robust liability funding prefer, and I wanted to add the funding. One of the issues and angst against us was the liability was not granular, and we were dependent on bulk deposits or market borrowings. I think if you look at our data, and we will show it to you later in the presentation, you will see our dependency on market borrowings, market deposits, bulk deposits has gone down considerably. We are not anymore a bank which is on a CD ratio of 100% and above. We are at 82%, 83%. We are not a bank which is dependent on borrowing or short-term funding from other banks. It's not the way we do our business anymore. I think if you benchmark us, I think you will benchmark us that we are best in class among the peers in that. Yes, the granularization exercise is still on. We are 41% as per Basel III LCR norms. We want to move to 48 to 52, and we are moving at a very fast pace. I can assure you this much. So I think the funding profile and the liability franchise also what we've created. I think when you hear Shaumitro's presentation today, you will see how differentiated the liability franchise is. We are not throwing arrows in the open market and saying it will strike. We can't. As a mid-sized bank, you cannot. You've got to have a very defined strategy on liabilities and saying, how are you going to grow liabilities and how are you going to grow market share in certain geographies, certain segments? And what is the next phase of that segmentation? And I think you will hear that presentation today and how we differentiate ourselves in the liability franchise. Strong product groups. I think, did you all know that we have the 3rd largest treasury in the banking industry, in the Indian bank? We have a global market group, which is one of the best in class. We are overweight on a global market book than the size of the balance sheet which we carry. And you can see that, you can compare it. And I think it's a business which we are proud of. And I think if we have time today, we will run through that presentation. Our transaction banking book. People talk about ecosystem, people talk about, oh, I do the ecosystem. We were always doing it. Maybe we've not advertised it. I think our transaction banking group carries a huge weight with the small size of balance sheet which we have on the corporate bank. It's the type of businesses, and we will give you some experiences and examples of what we've done in that area. And I think you will feel proud as to how this bank has differentiated itself. So for example, we are the largest escrow holder in the country. Whether it's RERA, whether it's NBFCs. We're very strong in these two verticals, real estate and the NBFC vertical. We get all the flows out of these. RERA, there's an escrow account. We manage the RERA account. 90% of the RERA accounts are with us. Lot of NBFCs go through escrows are with us. That makes us a differentiating proposition as we move to. We have created capabilities using Bharat Financial and how we do the power distribution and do the collection capability. You will see those examples and say, why have we got the best product groups to support our business units and get the value experience for the client? I think disproportionately large distribution. So when we look at our distribution, don't talk about 2,300 branches. We're not 2,300. We may be 2,300 physical branches on branch banking side. But we have a 1,900 BC-led branches in the microfinance side and another 1,700 branches in the vehicle finance side to support our business, which makes us equivalent to the large banks which are operating in India. We can convert them into deposit-taking branches tomorrow. We've already got the capability and the ability and investments done in the distribution as we create our business logics. So please understand, this bank is not a 2,300 distribution branches. It has what people call Bharat. We have a bigger distribution reach in Bharat than anybody else. 3,500 branches sitting in Bharat, tier 3 and below. We have 2,300 physical branches of banking related business. So we are completely different as a distribution franchise, and we've already invested in that capability as we move along. I believe we have one of the fastest and off the blocks on digital 2.0. Not as an enablement, but as a business. And you will see the launch or some shades of the Indie launch, which is our individual launch, and then followed by the SME, which we will launch in 3 months or 6 months down the road. You will see what capabilities and what areas we've gone and how we have differentiated ourselves from the others as we move into that business. It's not about a product. It's about an experience. It's not about selling a product through a channel. It's about basis the experience, how product flows into the clients. And I think it was a very, very differentiated experience. And a very, very experienced management team. And I think what you will see over a period of time, and I will introduce the management team members. A lot of you have not met the management team members. As a consequence, a lot of management team has changed. But we did it slowly and gradually without affecting the business. So there are no more the large orgs who are sitting. Absolutely young, energetic team which is there, who've taken on the businesses specifically in the domains which we have and how we are running those domains. So this is our management team, and I would request the management team members to at least raise their hands, because a lot of people have not met them and have been introduced to them. I think Arun Khurana, Deputy CEO. So when we say about a Deputy CEO, we say, what is a Deputy CEO? Can two CEOs coexist as a consequence? And we've seen how we've divided responsibilities and how we've run the business in a very, very... Arun continues to have specialization in global markets, and our global markets, I think the whole foundation, and he runs the product piece for the bank. So I think Arun Khurana, I think the Deputy CEO of the bank. Arun, can you raise your hand so that people see you? Yeah. Sanjeevani Anand, Head of Commercial Corporate Bank, I think been with the bank for long, but it's the orientation which has changed over a period of time. The way our businesses have undergone, I think Sanjeev Anand. Biju, the stalwart of the diamond business. I think been with the business for around 30 years, runs the business, and I think we don't have so many accounts, relationship. We just run 50 relationships, but we run them deep. That's the business. 4% or 5% of our book comes from BJ as a consequence. Sriram, who took over from Partha, you've known, I think he's been running this business. 18 years, 20 years experience in CFD, runs the whole, and see the transition. And we've never seen such growth, what we are seeing, and disbursements which we are seeing on the business. Very well acquainted with all facets of the business as we go along. Soumitra Sen, head of consumer bank, he took over from me, runs the full consumer bank in and out, including the consumer assets piece of the bank. Jay Sridhan, I think, ex-CFD guy, moved into banking, understood the CFO, and has managed the transition, and has managed the whole volatility in the microfinance which took it, and has seen the growth in the microfinance as we came along. I think Samir Diwan, head of affluent, comes from RBC. He was the CEO of RBC in Singapore as private banking, runs the whole affluent banking channel for us, and has created a fantastic business model which you will hear. Siddharth Banerjee runs the global markets piece, been with the bank, and has a lot of experience in global markets now. Rana Vikram runs the liability piece as a standalone individual, creates programs and how the liability should move, creates the transition. Govind Jain, the CFO of the bank, I think a lot of you should interact with him when you have the time, runs the finance function of the bank completely. Ramaswamy Mayappan, I think, runs the CRO as a continuity. We have the CRO who's there. I think Ramesh Ganeshan runs the technology and the CGMO piece, and been with the bank, manages that whole technology transition and this global markets. Ruben Modi continues to run the HR piece of the bank. Anil Rao runs the whole solution delivery and the operations piece of the bank. Anish Pal runs the wealth and para-banking piece. Anish, not there. I didn't see him. Charu runs the whole digital and the strategy piece of the bank in this. Rupa Satish, who was the corporate, I think, has done a fantastic job on the ESR capability and the portfolio management of the bank in the thing. Murli, who's not there today, is the compliance head of the bank. Jyoti Prasad comes from Yes Bank, runs the internal audit. Again, a new candidate who's been, and Indrajit Yadav, Sanjay Malik used to run the investor relation. Indrajit Yadav runs the investor relationships. So that's the management team all about. I think it's very important to put the faces behind it. I think, except for 5 people, all are new into the CET. Everybody is new into the CET. What was the bank known for? The bank was known for scale with profitability. I think you will recognize this bank again, except for the 2-year. We believe in scale, we believe in domain specialization, and we believe that we have to grow faster than the market in the phase in which we are in. I think we've, over a period of years, have given you a 23% CAGR on the asset side of the business. And domains have run that business. And you will continue to find domains getting added as we talk about the new strategy. I think you will see that domains have been a very, very integral part of our business. And when they did not grow, we did not grow our businesses. Deposits also, and people may not tend to, 21% CAGR on the deposit side of the franchise. And I think you will continue to see the growth. I think the retail growth will be higher than the asset growth as we move forward in our businesses. Our branch expansion has continued. We continue to believe in the branches. We are at 2,345. We will end this year at 2,500. And we will talk how we will come and how we will do our branch expansion. And we've continued to invest in our employees. I think we have 36,000 employees in the bank rules. We have another 28,000 employees in Bharat Financial and another 17,000 employees in IMFS. So we are a very, very large distribution and a capability which we have built over a period of time. The bank, however, and we must realize, faced external and internal challenges. And I think concerns on the corporate group came in. I think our corporate book, I think there were 5 accounts, 5 relationships which bled us. And I think we took inordinate highly exposures on them, and I think that's a learning which we've imbibed into the team. If you look at, our corporate bank today, I can tell you it's very, very granular and very, very. So I think we've learned from those experiences and we've gone ahead and moved ahead. I think government deposit, and that's where the granularization of liabilities is happening as a consequence. I think our high impact items, high touch contact businesses got affected during COVID. Microfinance business as well as our CFD business did get affected during the COVID period. I think we've countered that and we've come out of it very, very fine. Even if you look at the restructured book, we did not restructure microfinance so much because we believe that restructuring is not meant for, but we restructured the bus segment where we believe that there is a value proposition. We believed in the medium and heavy commercial vehicle where there was a value proposition. We did not restructure the personal vehicle segment. We did not restructure cars. We did not restructure scooter. Whatever small amount we restructured is because of the political pressure, by which we had to do it. I think otherwise, our restructuring was to do only valid restructuring. We did not restructure BBG so much. We did not restructure cards so much. We did not restructure personal loans. I do not believe they are meant to be restructured. It's better to let them flow and take the hits as and when. That is how I can clearly say I carry a book which is much more stronger than ever before because I've not restructured anything which is not meant to be restructured. And I think if you look at it, the bank's profit over a period of time, I think has grown gradually, except for 1 year where we saw a dip because of the COVID and we took more provision. I think the bank is back, and I think already you would have seen Q2 results. We've delivered a ROA of 1.81% and a profit of about 1,800 crores. And I can only tell you, what you will see from us is the granularity of the profit and no volatility in our earnings as we move forward. So you will continue to see this growth happening, and at a very stable pace and at a compounding pace. So you will see that as you go along in this business criteria. And we are very well covered on our provisions. And I think we've created contingent provisions and our PCR is 72%. All books are at 100%, 95 to 100%, except CFD, where we believe we've done a PCR of 40% because there's a repossession and the loss on sale of repossession is 30%, 25 to 30%. Otherwise, all our books, whether corporate, we provide 100%. Future, I provided 100%. You go to microfinance, 95%. You go to cards, 100%. I have created more, and I believe that's the right way to provide at 90 DPD rather than carrying and deferring your losses over a period of time. I don't believe in that. And I think that's the right way to run these businesses, and that is why these businesses are doing what they are doing as we move forward. I think the bank responded, and I think we created the PC5 vectors. And I think our PC5 theme was scale with sustainability. We changed scale with profitability to sustainability. And I think there was a very big, the learning was, how do you create sustainable growth with scale without creating volatility and such issues in the business, which we faced in. And I think the 5 themes which we adopted in that period were leapfrog digital banking, and you will see how digital has played a role when the digital presentation comes into play. Fortifying liabilities, and when you hear consumers' presentation, how have we fortified and how have we grown higher than the market in this place in what we have done. Scaling up domains of expertise. I've always said domains creates value, and domains will continue to invest in new growth engines, and we will talk about what are the new growth engines and how they have performed. And conservative and robust practices, specifically on credit, on technology, and on operations, and how the governance has played a very big role as we move forward in the business. I think strategic priorities were retail liability surge, and we gave a target of 48 to 52%. We will come at by the end of this year, we should be at 42 to 43, and should move to 48 to 52% as we move forward, because the liability has grown faster, overall liability. Fine-tuning the corporate bank approach, completely completed, and I think Corporate bank is now ready for scale, and you will see scale coming back in corporate bank. Holistic rural banking, and you will see how rural banking is a new. People talk about Bharat. We already had Bharat in bed, and how holistic rural banking and what contribution it has to our business. Scaling up of domains, and how will we enhance the domains as we go forward, and new growth boosters. I think these were the sustainability metrics. Credit to deposit ratio less than 95. We were around 116%. And I think we said we will or should be between 92 to 95%. And how we've maintained that. Certificates of deposit between 5 to 10. We've less than 5% right now on the certificate of deposit. Retail LCR between 45 and 50. You will see how closer we will get. We were 19% and how we've moved ahead on the LCR deposits. Unsecured retail in the credit card and personal loan and in the non-vehicle asset less than 5%. Because we have the microfinance book, we have continued to be at 3.5 to 4% on that book. I think PCR of greater than 65, we are at 72% on the book, and lower non-funded to funded ratio, we are lower to non-funded ratio right now. I think we also gave some numbers. We said our loan growth will be between 15 to 18% CAGR, and we will meet that numbers because this year's growth will be in 20s. I think the CASA ratio greater than 40, we are already at 42, 43% on that. Our revenue growth exceeds balance sheet. It's happening, our revenue growth is exceeding. PPOP loans greater than 5%, we are at 5.6 to 6, and I'll show you the trend. It's greater than 5.5% today. Branch network, 2,500 we will achieve. And customer base, I think we will end up at 33 million to 34 million because it got affected with the COVID-2 wave to a large extent. And that year the acquisition was slower at that point of time. I think, so once, this is the background on what the planning cycle. So where are we today? What have we done which is so differentiated, and are we ready to leapfrog into the future as we're talking about? I think if you look at all the 8 areas, whether it was liabilities, whether it was corporate bank approach, whether it was maintaining healthy margins, operating profit margins, continued investments on growth boosters, I think we have achieved each one of them, and I will go into details. I think look at these items, and when you go through, the foundation for the growth is almost there. Yes, on granularization of a liability is a journey. It will reach another 2 years to get there. But we are already very stable on our funding and the growth profile of the business. So let's start with liabilities. And that's the talking point these days, and I put that as the first slide. 80% of our growth which has happened on liabilities in the retail part of the business. That's one message which I want to give you. All our growth which is coming in now in liabilities is granular growth. It is not bulky money which is coming into play. We are very, very focused on granularization of liabilities as we move. And this has happened as a consequence of our NTB shaping up. And the NTB which has shaped up to about 500,000 accounts, which is gone. And I think that is the run rate increase, which I think in a quarter which you've seen on the business which has happened. And I think what you've also seen is the narrowing differential with large bears in the distribution network. We continue to invest in distribution. So a lot of banks, for example, our peers, or stopped investing in distribution. We continue to invest in distribution as we move forward and scaled up the new initiatives. Affluent and NRI came into their own. In a very tough scenario, Affluent and NRI delivered outstanding results for the bank as we do it. And our cost of deposits went down. And during this time, when the market is up 190 basis points, we are up 50 basis points. So I'm showing you the cost of deposits also and the impact. It is because the long-term nature of the liabilities which came into play. Of course, a liability will increase the cost of deposit, but it will not be at the same pace as what our market or the repo rate is increasing. And of course, our reduced concentration of deposit. We're now at top 20 depositors, 70, and we believe we will end this year at 13% of all. So we are already in line with the big banks on all this. We were 27%. We bought it down over a period of time. So I think there has been, all these 6 vectors show you what? They reflect that the bank is on right track and a dependency on the bulk deposits, on the market borrowings has reduced substantially. The large bulk deposit rates today are at 7.9%. And they were at 5.5, 5.6% about 6-9 months back. If my dependency was high of 30, 40%, my cost of deposit should have increased at a faster pace than what it has increased right now. Please understand this. The dependency is reducing on market borrowings and on cost. And as a consequence, the granularization of liability has come into play. And we will continue to be 50 to 75 basis points higher than the market on our pricing, which was 200 basis points earlier. We said till the time I achieve 48 to 52% at Basel III LCR norms. Strong liquidity buffers, and this is a question where I think a lot of confusion gets created on how the growth will get sustained. The questions are about growth, the questions are about sustainability. I think our LCR ratios are at 125%. All banks, good, bad, ugly, we are in the top 3 on the LCR. We continue to maintain our LCR ratios at 123%. With buffers in place on average liquidity, we've continued to maintain liquidity. I could have increased my NIM by reducing the liquidity. I would have dropped my liquidity and I would have improved the NIM because I'm lending at a very low rate in the reverse repo market. But I've said, for the sake of the organization and sake of growth, continue to maintain liquidity for the tough times, and we've continued to maintain liquidity. And I think our credit deposit ratio reflects that we've not over-leveraged the market. Our dependency on certificate of deposit is 3%. Our dependency on borrowing has gone down to 13%. And in the borrowing, 50% of our borrowings, and this is what the funding franchise comes because of the domain specialization businesses which we have. We get funding from SIDBI, NABARD at very attractive rates. So for example, we just picked up money from SIDBI in the month of October at 4.5% for 3 to 5 years money, which has no stat cost, no regulatory cost. So 80% margin plus our portfolios are eligible for refinance from the developmental associations, whether it's international, whether it's domestic, and we get funding, and we can raise this to 20, 22% at any point of time. It's just that we want to remain at a bar of 15 to 20%, and that's why we've not grown that business. It is refinance, and we don't. And if you look at our short-term foreign currency, it's only 5% against the market at 8% or 7%. We are at 5%. All others are long-term borrowing money for us. We are not going and doing borrowings at a different level and doing short-term funding. We're not doing that. So our funding profile gives us the capability to manage the liquidity and manage our growth. And that is where you will see our cost of funds, where our cost of deposit is higher, our cost of fund is only 25 to 40 basis points higher than the market because of the capability which we have, because of the businesses which we possess. I've talked about corporate bank, and you will hear the presentation, but I can tell you on restructured book has run off. It's very less left now. I think what is our standard book is now gone into 0.5% and go to 0.3% as we move forward. Our corporate book franchise is now very granular and very capable of running the business and is now pivoting towards a growth. What did we do in the corporate bank? And while Sanjeev will go into details on the corporate bank, I think the granular book has come into play. If you will look at this book now, it had long-term and large concentration. I think that has gone away in the business. And I think we've sold it down, or whatever hits had to be taken, we've taken and we've moved on with it. I think portfolio rebalancing has been done to chunky exposures. I think the credit has come out very, very beautifully. We've understood and we've rewritten the rules of the game on the credit sides. I think build specializations on specific verticals. 5 verticals which we believe are very important: health, RE, NBFCs, logistics and education, and one more. I think it's agri, I think. The 5 businesses and all of them verticals, and you see the growth on those verticals which has happened. Look, RORWA focus is a very clear focus, and we believe this with the reduced NIMs and everything can still deliver a 2% RORWA. And I think what they focus on 2% RORWA is a very, very important thing. And fee income is more granular than what it was earlier. So there is no investment banking income. You would have seen it. Their fee to asset ratio still is between 1.6 to 1.7. They cannot deliver 2.4% because it's become very granular and it does not depend on any bulky fees which is coming into play. I think this is something which I just wanted to share. I think this is the advantage of domains. Our book is at least 30 to 40% better on 60 DPD and 90 DPD, and this is indexations, than the market. Whether it's microfinance, whether it's CFD. We are much better than the market, and I think this is a testimonial of what domain specializations and what businesses which we have. And when people say, oh, they have a high risk, high return book, I do not believe we have a high risk, high return. I think we have businesses which are prone to high risk, which are managed very well, and the bank keeps contingent provisions against those businesses to reduce the volatility in the earnings. And please understand, these 2 businesses have done fantastically and come off very well now. And our gems and jewelry, which people, oh, this is a very high risk. We have no SMAs, no restructuring, no SMA1, no SMA2 in this business. And this is what we like. This is the slide which I like the best. Stable NIMs. Our NIMs have been range bound. And this is what you should get from us. Granularization. Our investment banking fees has disappeared. Our fee mix has moved towards consumer. Our fee mix is not dependent on bulkier deals. Our fee mix, our corporate fee is coming from very granular effects and trade as a consequence. Very different fees. Our range bound, is cost to income ratio. It may go up, but it will come back. It's range bound, 41 to 43. It may be up right now for some time and it will come back because it's range bound, the operation leverage is coming back. And I think, which is important, PPOP margins, which is among the best in the industry, range bound. We're not fluctuating on our businesses, and healthy provision coverage, again range bound, and with significant contingent provisions carrying. So I think the vectors of the business look very, very solid as we move forward. Very range bound, very, very fortified as a consequence of the provisions and the contingent provisions which we carry, and the businesses which we carry. We will continue to deliver improvement in margins as we move forward. And when you hear the PC6, you see how our margins will improve as a consequence of the stability which we have created in our businesses. And this is, I think, a new investments which we did. Our rural businesses have gone into 18% of the book. Sorry, can you get the presentation back, please? Yeah. Our net relationship value on an affluent, and when you talk about affluent, why are these guys getting into affluent? We are not a big wealth management people. You will see how the strategy has played out. If you would have played the wealth way, you would have lost the business completely. We cannot compete in the wealth right now. We don't have an AMC. We don't have an offshore branch. We competed in our expertise and created the wealth as a consequence of our expertise. And you look at the affluent banking, and you will see how the business is doubling almost every second year as a consequence of it. Our NRI banking, in spite of NR sustained flows going down, and our ability to retain flows going down because they were all being used for consumption, I think the NR book has continued to grow. We are now at 2.8% of the market. We should end the year at about 3.2%. We continue to grow this business as a consequence. Our tractor finance, we are 9.5% of the market, and we are third in this market. A lot of this business is with Kotak and some NBFCs. Kotak is number 1 in it. We are number 2 in it. And I believe we should continue to see the scale up on this. Affordable housing is a little bit of a disappointment. We thought we will touch 4,000 crore this year. I think we're still getting our act together on the affordable housing, but it's a business which we like, and we continue to grow within the CFD domain because clients belong to that domain. And our merchant advance is a new line of business which we had created. I think we will touch about 3,500 by the end of this year, 4,000, and you should see this business going to 10,000 crore in the next 2 years. This is a business which comes at 23.6% yield, at a fee of 3.5 to 4%, and at a credit cost of 2.5%. So fantastic business which we have created. Rural 2 tier to 6th tier business doing fantastically well. A very differentiated business through the Bharat Financial franchise. And of course, we continue to invest in our people. I think the structure in the corporate bank is a testimonial of how we've created the structure on our people. Our digital unit has been created as a separate BU, and 100 people are on board. We've created a digital experience center. I think it's a completely different capability which we've created, and I think our governance, our social, our audit, we have created a completely different assurance function in the bank to make sure that all the 3 units of the bank, which is risk management, compliance, and internal audit, come together and create an assurance function for the bank, which is very, very critical as we move forward. We are the only ones who've also created a system and a capability to manage the assurance function as we move forward. I talked to you about risk management. I think the learnings have been imbibed into our capability. I think we are focused now on granular loans and and working capital loans. It's not that we don't do term loans, but we do term loans for clients who have working capital loans as a consequence. I think conservatively we have focused on sector focuses. We've reduced the focus. So if you've not grown our RE exposure, it's still at 41,000 crores. We've maintained there as a consequence. So I think that's something which we've done, tightened our overall group exposures as well as sectorial exposures. I think data has played a very big role. We've invested in data analytics. We've invested in early warning signal systems. And I think an analytical team which has been created in the risk management unit is completely different. We've updated our policies and procedures. So there were policies and processes which had not been renewed for 9 years where the business had moved. We've now got a completely different automated system to track our policies, procedures, and governance around that. And I think launched digital management policy mutual ensuring timely review of these policies and procedures. So I think our risk management, our operational risk management has completely changed in the bank. And that is very important for you to know, that the bank is not talking about numbers, but talks about compliance, governance, and culture of the organization that has moved forward. And of course, on technology, I think our focus on technology has been on 4 different things. One is, how do we create scale and manage scale? I think in today's environment, how do we create and manage scale, and what is the infrastructure which we use? What should be on cloud? What should not be on cloud? Should we invest on our own infrastructure? I think we found our answers. And I believe we have a very robust, acknowledged by the RBI, that we have one of the best technology infrastructures which we create. For example, we created enterprise payment hub much ahead of the others, where payments, instead of going through one route, can actually get stored and forwarded at a very different time, because Finacle as a system has limitations to process transactions. It's how you manage the volume of transactions and how you create capabilities that's the number 1 capability which you create. Customer experience is our Sensex. What is the UI UX capability which you will create? How do you create personalization into the, what are the type of applications you need to create personalizations? What do you need to do that? And I think we invested in those applications. Our front-end capabilities and campaign management modules. Now it's not you download and do it. It is interactive with the clients at the point. Your new capability which you've created will personalize your screens, you personalize your thing as to what you want and what transactions you're doing and what is important. For example, if your bill is due, the first screen on mobile screen will show you your bill is this much, due on this day, but your balance is this much. Do you need to use the line of credit to pay the bill? That's the type of your screen change basis your personal. So if you're doing a shopping, did you know that you also have a shopping offer next to your house at this rate? So it's a very, very personalized and it's very intuitive to what you're doing as of now. So you'll see a very differentiated experience in this. I think top class IT, cyber security, best in class. I cannot ever say we've gone ahead of the market, but we are with the market on investment decisions on cyber security and our product innovation. And I think we will continue to invest in product innovations on IT to create the structure which we want to create. I think when people are struggling on IT, I can tell you, we invested last 2 years. And as we talk, we have 700 crores of capital expenditure in the IT to get to more new things as we move forward because we want to keep ahead of the pace on the IT, and that's our backbone. We've invested heavily into the IT space as we move along. And of course, our HR, and I think we never talk about it. I think the type of things we've done, we believe that employees create a long-term brand and a reputational value. We've not seen any attrition in 1, 2, 3, 4, up to 4 levels in the organization. Where we've seen attrition is in the front-end level. And we are coming out with an employment engagement strategy there also. I think the type of initiatives which we've rolled out, I think, for example, we actually rolled out a program of under Elevate for women in the organization. We do paternity leaves for parents and when they have babies, up to n number of, and 30 days of paid leave can be taken during the year at any point of time. That's the type of things which we do for our employees. And I think we don't talk about it. Everybody will do a learning module, chatbot, or mobile app. But what we do, we add that little bit of personalization into our employees. And I think that is very important. And that is the stickiness. Employees who stick with us, post 1 year, stay with us forever. Our attrition is within the first 12 months. It is not after 12 months. And that is where we are addressing the core issues. And I think we want to become the employer of choice, and you will hear it later in the presentation. As you grow your organization, employees play a very, very important and a very critical role as brand ambassadors of your organization. And we are investing in our employees. And this is what we moved. I think sustainability, credit to deposit ratios, less than 95%. I think our certificate of deposits continue to be at 5 to 10%. Our retail LCR continues to be at 41% against 45 to 50. Our unsecured retail is at 4.3%. Our PCR is at 72%, and our lower funded ratio at 2.85x. So we are completely aligned to the way we've said on the sustainability. We met all our sustainability index which we had set for ourselves with the board. And it is with the board, and it's in my KPI. That these are the sustainability metrics which we will do. And of course, now I'll come to the third part. So this is what has happened. How do we go from there? What is the growth parameters for this organization as we move forward? I think there are, again, 6 parameters which we are going to phase our growth on. I think loan growth acceleration. I now believe this bank is ready to 23 to 25% CAGR. Bank will deliver a 23 to 25% CAGR as we move forward into planning cycle 6. I continue to believe that this is what the bank is all about. This bank was not about 10 to 12% growth. This bank is about 23 to 25 with sustainability metrics in place. So the only difference is sustainability will come into play in all our businesses as we do. Deposit mobilization will continue till we achieve a 48 to 52% Basel III LCR. We will continue to give interest rates. It's not that we will stop the deposit mobilization, but our whole focus is granularization of liabilities, because we've seen as the interest rate cycle rose, we did not, if we were 40, 45% bulk deposits, the way we were, our cost of deposits would have risen very fast compared to the other. That is the issue. And the cost of deposit has started more. While you may give a higher, but the moderation in the cost of deposit in higher interest rate cycle happens because of the retail deposits which come into play. Leapfrogging digital, you will see us a big player in digital. Our experience is that we should be 5 million accounts in 3 years with a balance sheet of 25,000 crores in digital. That is the balance sheet which we want to create in digital. We want to be the biggest player in digital. And we will we have a digital, completely different BU created. And I think they have a business and a P&L number which they are going to go after. New growth boosters, and we will talk about the new growth. We've identified the new growth boosters for PC6, and you will see how new growth boosters will accelerate our business as we move into becoming the employer of choice. I've told you, you can't now if you're growing at 23 to 25%, that means your balance sheet will touch 550 to 600,000 crores on assets. If that is the funded asset balance sheet which you're going to get, you've got to be the employer of choice. Your people matter. You can go digital. It's about people. And I think whoever you have in the organization, you have to become the employer of choice. And I think the employer of choice creates a value in itself for the organization. That's a theme which we are going to play with. And sustainable banking, ESG will play a very important role in how we grow our business as we move forward. We've already inbuilt this into our credit, into our lending now. We are the only bank, when you talk about ESG, who's in the Dow Jones Index. And I think we got the best Euromoney award on the ESG right now. So I think we are very, very strong on ESG. And I think the type of businesses which you do lend itself to ESG also automatically. So I think we will talk about it. So ESG is a foundation on which we will, and it's a huge booster for us as we grow our business. I think domains will lead the growth. I continue to believe that we will maintain our market share or increase our market share in our domains. You will see us focusing on domains, and I think we will be ahead of the market on growth. That means we are gaining market share on this. And I think these are businesses which have done well, and we will continue to maintain our domains. And I think most of our domains are coming from cyclical lows as of now in the last 2 to 3 years. And I think we have a huge opportunity there. Grow corporate bank. And when people talk, oh, would you grow the corporate? We will continue to grow the corporate. I've always said our business will tend towards 55 to 60% towards retail and 40 to 45% towards corporate. It's not that we will stop the corporate growth. It is very important to get the risk-weighted assets in the bank going at the right place, because all retail businesses come at 75 to 100% risk weights, whereas corporate bank comes at a very different risk weight depending on which assets you do as a consequence of that. And scaling up of subscale, specifically the non-vehicle assets. And I think there is a huge opportunity to more than double the book in the next 3 years. And I think you will see that in the presentation. I think deposit mobilization, and I think our core is very strong. And when I will give you some themes where, Soumitra can expand. I think the segmentation which we do in our core is completely different from the segmentation which we do. Our market share on liability is about 1.7, against Kotak maybe 1.8. But in the home markets which we operate in, we are at 3.4. And we're going to expand our home markets and go to 5% in the home market. That's a very differentiated strategy on universal banking. We focus on segments, we don't focus on mass. We're not in the salaried segment. We focus on NRI, we focus on affluent, we focus on business owner. And as we go forward, we've done client segmentation. We will focus on communities. I believe India is very vast. If you look at South-based banks, ING Vyasa, for example, is a community-based bank. I think there are different communities which may not be on caste, maybe on business. Example, diamond is a community. We are very big on diamonds. We are number one in the world. There are 1 million workers which are employed in diamond. They have a 1 lakh average salary. Look at the opportunity which we are sitting on. If you go into another segment like doctors, you don't have to go to doctors. Everybody go to cardiologist and the gynecologist. It's a very different opportunity of a different nature. So I think we've identified 5 segments like this. And we believe community-driven growth, playing with the ecosystem, is a very differentiated way of doing liability. The next phase of our growth will happen through home markets and community banking. Community banking will take a very different way of life in this bank as we move forward. Continue scaling up a new affluent, we're doubling our book on our affluent, doubling our book on our NRI segment. Our SME and business banking will continue. They come with liabilities. And of course, the rural banking, the micro banking, and which you will hear JS talking about, is a huge liability wallet which we're waiting to get. Invest, I think, merchant acquiring acquisition gets you 35% of their asset growth comes in the liability business because of they are self-funded. Agency business of the government of India and digital initiative focused on individuals, which I said that if she can create a 25,000 crore book, we are completely out of the issue as far as the liability is concerned in the way forward. And of course, this is the roadmap. I think we've created capabilities. We have the best capability on credit card and personal loan today. We can churn out a credit card in 2 minutes. We can churn out a personal loan in 3 minutes. Completely automated, completely digital capability. We are churning out individual loans of SME in less than 2 crore, approval rates in less than 5 minutes as we move forward. And what you will see, the individual launch and the SME digital, a completely holistic capability, segmented capability coming into play in the next 6 months. So you will see in the first quarter, on the financial year, this financial calendar year, sorry, you will see the individual launch. In the second quarter, you will see the SME launch coming into play. And of course, the scaling up of new existing vectors. I've talked about affluent, NRI banking. Tractor finance is another vector which we believe in. We believe it's a great business. It adds to the agri. We want to be number one in it. Stated number one financier in tractor finance. We want to be that. Affordable housing. If we are not able to do it, we'll go the inorganic route. But we want to scale up in affordable housing, MSME, and the merchant acquisition business. And all these businesses will be very, very large-scale businesses in the bank. And adding new growth boosters. And I think home loans, we've started the home loan business. We believe in 2 years, we will have a 10 to 15,000 crore book in the home loans aside. Investment banking is going to get launched this year. You will see the investment banking coming into play. We've had the team, we've grounded the team for the last 6 months to 9 months, and you will start seeing the results in the short while from now. And of course, para banking is a very big area where we want to get into. We continue to await RBI's approval, but I think it's an area where we believe we can make a huge impact in the. And of course, I don't want to comment on it, but I think employer choice may mean different things to different individuals. I think the more important part, I think, is the environment and the culture which we create in the business as a policy. I think what we have as career progression, and I think we have a continuum. So all our senior managers now, going forward, will come as a consequence of the internal. So while we will hire 20% from outside, 80% will be all ingrown talent. We have enough pool now, and we believe all our branch managers, regional heads, zonal heads, and the various other segments, operations head, will all come internally. We are not going to hire from the market as we move along. And I think pay our benefits, market link by pay and benefits. And I think the pride and trust has to come into play as we move forward. I think in next 2 years, you should see us being the employer of choice in the banking industry as we move along. And of course, we've talked about it. I think we've done a lot of work on the ESG side. I think our themes have played out on the ESG. I think our credit is all about having, I think we're going to now launch differentiated products for women, solar financing, EV car finance. So we are going to create products which are linked to the ESG business and are going to get into it. So green deposits was one such example, but I think there are differentiated products, and diversity and inclusion will be a big theme which we will do. So whether it's in our employee force, whether it's with women entrepreneurs, I think diversity will play a very, very big role as we move forward in our business. Of course, and this is the planning cycle 5. I don't want to repeat it. We are already meeting our objective of it. Again, so what are the themes of planning cycle 6? And I think this is the important thing. I think domains to contribute greater than 50% of our business. It's 43%. That means our domains will continue to be very, very strong. We will maybe add one more domain as a consequence. But 50 to 55%, we will be a big bank in the businesses in which we do. So we are a large bank in the businesses which we do, in number 1 or number 2 in that industry. So that is surge in client acquisition. We will acquire 500,000 accounts a month. We will increase our run rate to 400,000 with the digital, moving to 500,000 a month. We will acquire 5 million customers, branch banking customers a year. And that is very, very important for us. From 1.22 million, we will just surge it to a very different scale, a different level of business. I think continuous gain in the market share, specifically in vehicles, SME, MFI, cards, and deposits. You will see us gaining market share in 5 businesses. And I think that is something we will continue to gain market share on. I think digital 2.0 will play a very, very big role. And I think you will see us being a very, very, and a different sub-brand coming into play on digital in the thing. Home loans will play a very, very big role for us, and private banking get launched, the bank, as we move forward. I think sustainability to the core. I think ESG will play, is a very dear and para-banking, we await the license, but we want to get into 3 areas: AMCs, securities, and non-life. That's a stated intent. We want to get into these 3 areas. And these are the themes which will drive our business as we move forward. Ramping up of secured retail assets. And I think mortgage, affordable housing are 2 themes which we want to work on. Our tractors is the 3rd theme which we want to work on. I think these are 3 businesses where we believe we can make a huge impact in the business. Micro banking in rural India. So when we talk about MFI, we're not going to do JLG only. JLG will be very small part of our business. Maybe from 90% it will go down to 60% of our business. 40% of our business will come from 3 other areas: merchant acquiring business, home improvement loans, loans against property in the self-occupied residential property, and scooter loans. We will become very, very big in this. And we will create a book of 60,000 crore in micro banking, and 20,000 crore to 25,000 crore will come in these areas of business. And the JLG business will be 30 to 35,000 crores. So, but these also come at a very high yield, so as a business. Used vehicle scale up. We are going to become the biggest players in the used vehicles. We are already at 3,500 crores at less than 1% delinquency at 15.5% yield. We believe this is an opportunity to go to 10,000 crores. We have a very big plan to grow this business. We want to be the number 1 aggregator on used car business. And we have created a portal. We created capability, digital capability. You will see that launch. We're completely online, real time with the aggregators on this business. We want to do that. Indie launch, which is our individual launch of the digital, and scale up will be the next big opportunity on the digital side of the capability. Investment in distribution. We continue to go to 3,500 branches. I believe we should expand our distribution. We need that type of distribution in the branches. Continue to expand that. Doubling of affluent and NRI, which is a very important initiative, including launch of private banking as a consequence of that. Digital SME and MSME penetration. Digital will play a very big role in this. We want to be a market leader in this business. And how we do it is a plan which we are coming out with. Imbibing ESG in our business. We continue to maintain number 1 position in the ESG. We want to be the number 1 player in the ESG. A lot of funding to the bank comes in, capital comes in as a consequence of ESG. As a consequence, and I think we will play. And I think addition of 4th domain. So you will see us adding a 4th domain. Whether it's It's, I told you 50 to 55% of our portfolio will come from domain. We will add a fourth domain to our business, which will be a 10 to 11% market share of that business, which will come into us. Whether it's, we've identified the businesses which we want. I think it's only a matter of time that you will see the domain coming up into the play. And of course, loan growth ahead of PC5. So we said 16 to 18. We are saying 23 to 25% growth rate. I think loan mix will change to 58 to 60% retail, 40 to 42% towards corporate. CASA ratio greater than 45%. We are saying we will be able to granularize and go to 45%. I think PPOP of the loans, we've raised the target from 5% to 5.5%. We are already at 5.6. So then, yeah, branch network greater than 3,000 crores and a customer base of 50 million clients as a consequence. So that's all I had. I think I can answer any questions which you have right now and take it forward. Just if you can have the question and answer session for about 10 minutes. And the management team is here. If I'm not able to answer, some members of the management team can answer. You can raise your hands. Yeah. Yeah, this side. Yeah. First table, yeah.
Hello, sir. Thank you for the opportunity. Sir, my question on the home loan product side, you said we are going to launch home loan product. So what is the target segment for that product? And secondly, what is the yield, basically yield and the target customer segment for the product?
When you look at a home loan, please understand, home loan never gives you a 2% ROI. Let me tell you, 2 to 2. It is a product which works between 1.3 to 1.4% ROI. Yeah, but if you look at it as a product, but if you look at it as a customer, I think the customer profitability is very high because the customer ownership of product goes to about 5 to 6 on a home loan product. And I think our focus is to cater to our branch banking customers. Our branch banking customers are near mass affluent and above. So that's the market which we go on to the mortgage side of our business. We are not interested in 10 to 20 lakh or 30 lakh home loan products.
And it will be rolled out to all our branches?
It will be rolled out to
all our branches?
We are rolling out to about 20 centers in our 20 states right now. We're not going to roll out pan-India.
Okay. Secondly, sir, on the tech spend side, you said 700 crores of something we have spent for last 2 years. So in terms of one is the product innovation side and the new experience for the customer. And third is the team of, you said 100 plus people working the digital side of the activity. So in terms of our cost to income ratio, which is, if I compare to other retail banks, our is on a higher side. Obviously, because of mix, it is a higher side. When we'll see the benefit of those digital initiatives coming into in terms of better efficiency and a better cost to income ratio?
So if you're comparing us to HDFC, which is at 37%, it's wrong to compare. They are a balance sheet of 10 lakh crore and the operating leverage comes into play. Operating leverage comes into play at a particular point of time. We've said our cost to income ratio should be in the range of 41 to 43. We are at 44.6%. You should see the leverage coming back into play. In the next 2 to 3 quarters, we will go back to 41 to 43%. And as a consequence, in the next 3 years, you should see us at about 38 to 39% operating leverage.
Thank you.
But I think you should assess us on the PPOP margin rather than the operating leverage margin. It's very important. Because we'll continue to invest for growth. Yeah. Yeah. Sorry, just the speaker.
Fourth domain, you mentioned parabanking, AMC, retail broking, whatever. How soon do you see we getting approvals or scale starting that?
Parabanking, I cannot comment, but the fourth domain will come in very soon.
So through acquisition or?
Inorganically or organically, I think we have a site. We've always grown through inorganically on the domains. But let's wait and watch.
Good luck for that.
Yeah.
Yeah, Sumant, I just want to ask you, at the rate at which you are going, I don't think you'll need capital for the next couple of years if you are going to grow at 23 to 25, generating a healthy ROE. Is that a correct statement or?
So we continue to assess our capital requirements every 6 months. And that is the way we should assess. And I think we don't want to be below CET1 of 14%. That is something which have created a hurdle rate for ourselves. I think, in my view, the internal accruals are enough to take care of growth. I think we will, in 3 quarters from now, assess whether we need capital or not, as of now. If there's an acquisition coming in way, we may need a capital at that point of time. For the growth of the organically, I think what you say is right, that we may not need the capital for some time.
So it's only the inorganic initiative which will sort
Yeah,
of lead to value.
or we feel that the macro environment is such, and we don't wait for the macro environment to get down to a level where capital is not available, we may raise capital at that point. So I think we don't need it right now. We'll evaluate in 2 to 3 quarters from now. And I'll come back to I will inform you much before where we are raising capital. We don't need capital as of now.
Thanks.
Yeah, back. Somebody has to go back.
Hello. Sorry. So my question is on the retail deposits. So as you have set targets of 45 to 50%, but if you see in terms of strategy on liability or branch banking, it's more focused on NRI or affluent banking.
And community banking.
And community banking, which by nature are more wholesale in a way and less of retail. Right. So how there's a disconnect between how we are going to bridge this gap on the retail deposits, because the HNI or the affluent banking will bring in more wholesale or bulky deposits.
No. You're absolutely wrong. All HNIs come in with deposits of 1.5 to 2 crores. Individual. They're actually individual. If you look at communities, it will all be individual. Home markets are all individual. They don't come in with these type of deposits. No.
No, we saw this trend in Kotak this quarter itself, how the HNI deposits, some of them actually ran down as we saw the rates go up.
What ran down, it is absolutely wrong. What ran down was an agency account. Agency account where RBI now has said on the nodal accounts where they transfer monies to the bank, whether it's shipping, whether it's transport sector, whether it's aviation sector, defense sector, they've taken out 5 sectors and they said on these agency account or health, in these agency accounts, money will not go to the bank from the treasury. It will go directly to the end user. So they are now working through their own treasury. That is the reason. There is no such flow. It is a treasury flow of the government of India where they change the way the flows happen. All treasury flows used to happen to banks, and from banks it used to go to the other. Now they said my flows will go to the end user. That's it. So for example, if they were to distribute money on any subvention, it will directly go into the customer account. It will not come to the bank. That is the way our government of India treasury is working now.
Okay, thank you.
It's not the HNI flow out. It's absolutely wrong.
Yes, okay. Yeah. Go ahead with the question. So I wanted to understand your thoughts on the fintech partnerships. We see a lot of banks partnering with various fintechs with a viewpoint of acquiring customers, probably coming at a low cost. So what's our thought process on fintech partnerships when it comes to adding new customers? That was the first question. The second question was also a lot of banks are focusing on payment platforms. So payment, I believe, is a very big thing for the banks, but I probably missed out or did not hear anything on the payment platform strategy for the IndusInd Bank. So these 2 things, if you could highlight, would be great. Thanks.
So payment, so let me answer the fintech part. I think we continuously believe that collaboration is the way forward. I think the rules are getting more and more clear on the fintech relationships and how we have to move forward. I think the digital lending norms or the fintech data privacy laws are now coming into play. And I think these are laws which are preventing us from doing very deep-rooted fintech relationships. I think there is a way out now, which we feel is the way forward. We've just approved, we've sent to the board a note on how the fintech relationship. But I think, please understand, I think while we will do collaborations and partnerships to get best in breed, which we do already, and you'll hear it in the digital presentation, but I think creating your own real estate asset is also very important as you move into the digital. So I think while partnerships will play a very big role, and you have to create value-added partnerships rather than core partnerships. So if people say savings account acquisition can come through a fintech partnership, I don't think it's a value addition. What can come through a fintech partnership is a merchant supply chain partnership to a right. So that is the way. You have to say where you create a value of a very different and complements you. Where you create a value to support you in what you are doing to scale up. I think you will suffer in the long run, is my opinion in this. And I continue to believe banks which are saying that they are tied up with Open or they're tied up with XYZ and they will do the business and they will start, I think is a great way to acquire a customer, but the customer is never theirs and it will not do a cross-sell capability. The profitability of that customer is very negligible as a consequence of that. That's number one. On the payment side, I completely agree with you. I think there are three ways to do. One is to build your own stack. I think we have a payment capability now on UPI, on payments, which we have created. We are also now in discussions with the digital. We have acquired a payment capability through M2P. We believe it's a very, very big initiative for us. In the digital, you will hear how that stack has been created and how payments is going to be a differentiator. We're also talking to a strategic partnership with the payment firm. And I think whether we take a participating stake or acquire it is a different issue. But I think a strategic partner with a participating stake in that place in the payment space itself.
Cool, sir. Thank you. Sir,
Yeah.
it was a great presentation.
I can't hear you.
Yeah.
See you. Where is your?
Here. Yeah.
Oh,
Sir,
at the last.
yeah. So I am Rajorshi Pallit. I am an ESG associate at Quantum Advisors. So I had certain questions with respect to social end of the bank. Now the bank is lagging behind its peers on gender diversity. So what steps is it taking to bridge the gap first? And secondly, there was this entire executive exit which happened in BFIL. And there were some issues with respect to proper procedure, HR procedures, which were not followed. What kind of steps is bank taking to reduce such or remove such issues which can happen in the future?
So let me answer this. Gender diversity. So we are very cautious about gender diversity. I think if you look at the banking part of our business, yeah, you have a very good gender diversity. If you go to CFD, where it's a very rural and a very different business, the gender diversity is low. So we have to say, how do we balance that? That is the concern. Bharat Financial also, in the deep rural areas where you have to work, I think a little bit of a gender diversity issue comes out into play. So we are finding ways to address that. It's not simple to address it, but we are finding ways to address those issues. And maybe banking business becomes more gender diversified. In collections, in these areas, you can't put a gender diversity because it creates, you can put them in telecalling centers, but you can't put them at feet on street at that point of time. And I think we are cautious about that, and that is the reason. But our call centers are becoming more gender diversity based, and that is where we will balance this. So I think we are very clean on the steps which we have to do, and you will see this moving to 21 to 22% from 18% what we are today to 21 to 22, which is the best in class in the banking sector or in the industry. Now let's go to your second question. On the HR side, there were HR issues. I think there were multiple issues, not HR issues. I think the HR issue was that we did not know that these guys were looking out. How? That's not an HR issue. It's a market issue. That the guy is looking out and doing a deal. That's not an HR issue. The HR issue is that there was a contract which said that they cannot take employment anywhere for 12 months. But we found out legally that you can't reinforce the contract. Let me tell you, the applicability of a non-compete agreement which is not registered in law and not available by law can be done on good faith basis, but cannot be reinforced if the person, you can do a case, but you can keep on fighting that case. I can assure you, there is no value addition of that and specifically, the bank had to take control of the businesses. We were running it like a microfinance institution, and I think we sent Sridharan there to take charge of the business as a bank. And I think that is what you are saying. The agility of microfinance with the processes of the bank have come into play in the institution now. And as we talk, we are very comfortable with the microfinance business. Yeah.
Thank you so much for your time. Just a question around the microfinance business, because your vision is to shift towards a micro banking sort of a structure. And, you know, with the changes in norms around individual loan exposure versus household debt, you yourself have mentioned that rejection rates have gone up. How do you see this micro banking vision, strategy, and a structural ROA of this division going forward?
So, in fact, it is in line with the strategy what the RBI wants to do. Actually, it is in line. You are balancing the book. They were scared about over-leveraging in the unsecured side. Let me be candid. That is what, and what people were doing is, clients were being moved into an unsecured business in the team of business loans, EBLS or whatever you call them, yeah? And they were being given loans of 150 to 200,000. We said, going against the grain and giving 200,000 to 250,000 to a client whose loans today are 40,000 is against the grain. There's a difference between intent and ability. And how do you find the right balance in the intent and ability? And I think the right balance is you have clients who are doing well, do their household assessment, create a scorecard, and give them a secured lending as a consequence. And as they move forward, the secured lending and what it comes through comes as 18%, 16 to 18%, and with a very secured, his self-occupied house and property, or a home improvement loan, or a scooter loan. All these yields are comparable to the individual yields, and the biggest thing is grow the working capital business in the tier 3 to tier 6 cities, where the yields are at 23 to 26%, and you can continue to earn, and that will balance out the yield if the home improvement or this comes at 60. So the balancing of the book, while you continue to grow, the ROA of this business will continue to be between 4.5% to 5%. It will never be 7% because we will keep contingent provisions. Does this answer your question? Yeah. I'm there. You can ask me more questions. We have to get, or we will. You hear the individual presentations. I'm available for any questions throughout the day. And I think during lunch, we can have an informal chat also. I think thank you so much, and thank you for coming and spending a day with us. Thank you so much.